Today we have Rhett Kessler, Portfolio Manager with Pengana Capital. Welcome, Rhett.
Well, nice to be here. Thank you.
And you started or joined Pengana in 2007. What were you doing prior to that, Rhett?
Well, I've been in the industry for about 20 years. I cut my teeth, as you can hear from my accent, in South Africa. Came out to Australia probably about 18 years ago now, and started working at S.AG Asset Management, where I ran money for quite some time. Interestingly, in 2006 I took a sabbatical because I thought I'd lost my mojo. I had no idea there was a financial crisis coming, but it did feel a bit crazy to me. I thought it was me. So I bowed out and started my fund actually 3 months before Lehman's went bust.
Interesting timing. Rhett, the fund that you're running these days is known as an absolute fund. Do you want to explain what that is?
Yeah, I guess it goes back to what I'm trying to achieve by having the fund. I'm managing the fund, my own money's in the fund, to create financial independence. And financial independence for me is that my wife and kids can live in the manner they'd like to become accustomed to, whether I'm there or not. Now, the problem with running a relative fund is it's very hard to pay school fees or feed your family out of relative returns. And that's why the need is to focus on absolute returns. So at the end of the day, we need to preserve capital and actually make money independent of what the market does. And we call that an absolute return fund.
Okay, that makes a lot of sense to me. Is that a growing trend?
I would have liked to have thought so. A lot of our direct high net worths think that's the way everyone manages money and can't seem to wrap their heads around why someone would, if they can't find things to buy, still buy things that will lose money because they have to be invested. I think it's quite compelling, but it's also got caught up in the whole hedge fund industry, which is a big growing industry, where they go long and short. We're long only, but focused on absolute returns.
When I look at the reports that have come through on your fund recently, I notice you're sitting on a lot of cash. Why is this?
Well, we'd prefer to be fully invested, but we believe in the mantra that if we can't find things that can preserve capital and make us enough money to justify the risk of potentially losing capital, then we should stay in cash. And because we've got such a strict discipline around that hurdle rate, when things get expensive generally, although we're bottom-up pickers, we tend to have more cash. And as you've seen, the greed button's been well and truly pressed for the last 18 months. And so things have got quite expensive, which means there's a paucity of great opportunities.
Yeah, well, that leads me to my next question, which is, where do you think, or what's your prognosis of the international market at the moment?
We're not big macro predictors, but in summary, I guess the US is recovering nicely. It's a bit patchy, but recovering nicely. Europe, I have some concerns because it looks like they're continuing to kick the can down the road for somebody else to deal with. And China's got enormous capacity to really kick the can quite far down the road because they've got a lot of reserves. And I think they're doing that to some extent. So I think the States is the major driver of global growth. But equity markets, they are fairly fully priced as well.
Okay, well, you mentioned fully priced. That's interesting because when we look at the New Zealand market, I think we're at an all-time high now. It took a long time to recover to these highs, but we are there now. So where to from here? And what do you see in markets?
So the first thing I'd say is we find it very hard to predict what the market in general is going to do. Anybody who can take industrials, resources, financials, predict them accurately, and at the same time work out what the currency is going to do and predict whether the greed button versus the fear button is going to be pushed is a lot smarter than we are. We work from the bottom up. Typically, if we're fully invested, it means we see a lot of opportunities. And if we're not so fully invested, we don't see a lot of opportunities. So at the moment, being 75% invested means that the devil's always in the detail, but there are pockets of opportunity. And we intend to take full use of those. The world's a big place. There's a lot of opportunities, always. Think about even during the Second World War, people made money. And we think a smart investor with a lot of experience who works really hard and is very disciplined can make money under most circumstances. And we think this is one of them.
So in real terms, you're a very high conviction manager. You really believe in the stocks that you put the money into.
Correct. We've been accused of being anal. We think we're granular. But at the end of the day, I always find that the harder we work, the luckier or the more money we tend to make, and the luckier we get. And that's always been our motto, the devil's in the detail.
Yes, that's an old adage my father taught me many years ago, so it's one I'm well aware of. Turning to interest rates, do you see, do you have a view on when there may be a lift in interest rates, or what do you see of opportunities around them?
Yeah, look, given that 85% of the world's market cap is currently operating in interest rate environments of 0.5% or less, you've got to say that the tailwind of ever lower interest rates is probably completely played out. Guessing when monetary authorities feel it's safe enough to start applying rational interest rates is a very difficult prediction, and we don't try to guess that. So I don't think we're skilled in that. So what we say is, if companies are smart and continue to use very low interest rate environments to lock in long-term money, that's good for shareholders. And we like companies that do that. And that's more the angle we're playing.
Okay. So just focusing a bit more now on Australia, from this side of the ditch, when we look over the Tasman there, it does appear to us that growth seems to have stalled in Australia. Comments?
Yeah, I think there's a lot going on. You know, we always used to talk about the two-speed economy with resources and non-resources. I think the resources party is over. There's no doubt about that. On the industrial side, the East Coast is actually quite resilient. And there's another thematic that's playing out in that there's a bifurcation or a split between the rich getting richer and the poor not getting so much poorer, but just not doing as well. And so if you've had assets in the last 3 years, equities, property, your own business with a bit of debt against it, you're feeling quite good about yourself. If you've got a job in white collar or blue collar, you probably haven't had a pay rise for 3 to 4 years. You've probably got high non-discretionary inflation in all the things you have to spend money on, so medical bills, rates, school fees, etc. And lastly, you've probably got some job insecurity. So there are a lot of moving pieces, and I'm sorry to come back to the same old adage, but again, the devil's in the detail. There are pockets of opportunity, but there are a lot of risks.
I remember someone telling me years ago that resources outperformed 1 year in 7. And you know, we saw a huge outperformance in resources, but clearly it's come off the top. That's very clear. Now, is the feeling in Australia that they're going to rebound, or or is it going to be much more a sedate recovery from here for resources?
I think as long as there's uncertainty about global growth, and in particular Chinese growth, that commodities in general will be under the pump. However, there are some unique industries in Australia, commodity-based, where we are the lowest cost producer in a long way. You know, Rio in iron ore comes to mind, where even if half the demand disappears, Rio can still make money. And I think you've got to look for those special situations. Having said that, trying to predict the oil price, gold price, iron ore price, I think is fraught with difficulty. Frankly, I don't think anyone can do it. We certainly can't, and we steer away from those kind of things.
You touched on there on your way through there, low-cost producer. That's interesting because I agree that from what I hear, there are some low-cost producers, but I do understand that Australia's cost base has really risen, and in particular in their labour rates and some of the union situations. Do you want to explain or want to talk about that a little bit?
Yeah, I think until government's changed recently, labour costs continues to get out of hand substantially, and it's going to be very, very difficult to bring them back down again. The best we can hope for is a stabilisation in the increase of labour costs. It creates enormous problems for many companies in every sphere, and to some extent it's only recently that the foreign exchange has acted as a bit of a shock absorber to try and assist with that. At the end of the day, Australia is a country that relies, to be globally competitive, has to rely on productivity through capital equipment and IP rather than labour. Is my summary.
Yeah, no, I think that's fair. So where do you see the opportunities? Clearly, from what you just said, you look at individual companies and you look at that, and that I concur with. But is there a sectors or any particular areas that you see more, where there are more opportunities than others at the moment?
Yeah, we're very excited about some of the mid-tier financials. There's companies like S.G Fleet or Credit Corp, where they've developed very high IP in managing those widgets of money in a structured and clever way. Another area, perversely, is the healthcare sector, and I say perversely because they're focused outside the country. So ResMed is the global sleep apnea leader, together with Fisher Paykel, which many of you here will know. And then also we've got the lowest cost producer of blood fractionation products globally in CSL, which is a big industry, it's a big company, massive barriers to scale. So those are some of the opportunities we see.
On the other side, what are the things that you think investors should be concerned about?
Well, I think the biggest concern should be this focus on index benchmarking. We've noticed that many people have to be fully invested, and when I speak to my peer group out there, you say, how's your month going? They'll say, oh, I've had a great month. And when I ask them how they've done, it's always measured against the market. So if the market's down 4 and they've only lost 3, they think they're having a good month. I think investors need to realize that for fund managers, if they benchmark them against the index, they will manage against the index.
Volatility. You know, investors dislike seeing too much volatility. Any comments on that?
Yeah, I think they've been rewarded, because for the last few years, volatility has been remarkably low and below trend. And I always say that the only way you get back to long-term trends, if you've been below trend for a long time, is to get above trend for a while. I would say my best advice is to focus on fund managers who have skin in the game and dislike volatility as much as they do.
So that segues nicely into my final question, which is, what's the best financial advice that you've ever been given?
Well, my dad always used to say rule 1, 2, and 3 of managing money is don't lose any money. And that's basically our motto. First and foremost, we make sure that we don't lose anybody money. It's great money can be made by not losing when times are tough, and then knowing when the sweet spot arrives.
Thank you very much, Rhett, for that, and we look forward to working with you in the future. Thank you very much.
Thank you.